Most people are watching Bitcoin's price only. Very few are actually looking at the liquidity, and almost no one is looking or paying attention to what traditional markets are quietly signaling right now. Because something extremely important just happened, and if history rhymes, as we say in crypto, it tells us what is coming up for crypto in 2026. We'll talk about Bitcoin right now and the levels that it is claiming. Another very important indicator, Russell 2000 just did something it has never done before. Liquidity is turning back on and risk appetite is returning, but very few can see this. And yet, crypto interest is near multi-year lows. That disconnect is exactly where opportunity is born. So let's go through a couple of charts. First, we talk about Bitcoin and the setup for this week, what we are looking at. Bitcoin recently swept liquidity below the 90k level, and that move flushed out late longs, stop losses, and weak positioning, exactly what strong markets need before continuation. And instead of breaking down, Bitcoin bounced aggressively from that area. This tells us that buyers are still active, demand is stepping in, and the market is defending higher levels. So the next key resistance sits between the 92.5k and 93k level. That's the first one. Then we've got 95k, 98k, and 100k levels. So the first test of the 92.5 and 93k levels, this is the first zone to be tested. But as long as Bitcoin holds above the 90k, around that level, the structure remains bullish. And if we see a daily or weekly close above the 93k level, that opens door for momentum to expand again, not just for Bitcoin, but for the entire crypto market. And I think this is coming up very soon. This week we have important data, CPI and PPI data. So this will cause a lot of volatility, and we'll see probably Bitcoin going above 93k level, then dropping down to 90k level, and so on until it decides, depending on the data, we'll see in what direction we're going to go. But what Bitcoin is doing is just doing its job, clearing liquidity, resetting leverage, and rebuilding the base. This is what strength looks like, even when it feels boring, because we've been in this range consolidation. We've seen consolidation within this range now for a couple of months. But the longer we consolidate, the bigger the next move to the upside would be. Then another signal that I want to talk about is Russell 2000. Here is where most people miss the bigger picture. This index, it tracks small cap US companies, and it just broke above 2,600 for first time ever. This is not just another breakout. This is huge because small cap stocks are the highest risk segment of traditional markets, and they only outperform when liquidity is returning, financial conditions are easing, and investors are willing to take risks again. And what we see in general is large cap to move first, then mid caps and small caps, and we've already seen this rotation happening in stocks. If you're in stocks, you would have noticed that we have record highs for some of the stocks over there, and now we see small caps also starting to outperform. So when the Russell 2000 leads, it tells you that money is flowing back into the system. This is one of the clearest signals. This is one of the cleanest signals of risk appetite returning. And historically, whenever this index enters a strong uptrend, crypto follows after that. And this is the sequence most retail investors don't understand. Money flows like this: cash, large caps, small caps, risk high assets when it comes to stocks, and then that comes to crypto. Crypto is not first, but crypto is the fastest, which means when you see small caps breaking out, crypto is usually early, not late. This is why this Russell 2000 index moving first is completely normal, and this is why ignoring this sign is actually dangerous, and you might miss the next wave that is coming to crypto. As I said, what is happening, it just means that more liquidity and easing is happening. It's not speculation, this is policy. We have the Federal Reserve buying back T-bills. That directly adds liquidity into the system. Trump has ordered $200 billion in mortgage bond purchases. That injects liquidity through housing and credit markets. We have the US Treasury still releasing funds from the TGA. More money entering financial markets. And Trump is talking about tariff dividends, which is direct cash into households, and he's also talking about tax cuts and tax refunds, which is more disposable income. This is liquidity, this is stimulus, this is financial easing, even if no one wants to call it quantitative easing, but this is what it is. And markets don't care about narratives, they care about flows, they care about money. And flows are turning positive again right now. And while we see money flowing into the system right now, Crypto, the interest to crypto is very low. Crypto has been in a downtrend for about 3 months now. We had October the 10th crash, which basically flushed leverage, destroyed confidence, and shook out weak hands. This is what happened, and order books are so thin right now. Speculators are completely gone, and sentiment is low. But this is very important because strong rallies don't start when everyone is excited. They start when participation is low, interest is gone, and positioning is light. And that's where we are now. And if we look at this chart, which I want to share here with you, crypto interest online right now is extremely low, lower than we've seen in years. Some people blame social media algorithms, and yes, they do affect reach, but the real reason is very simple and it's different. The market is quiet, moves feel controlled, and there is nothing exciting to talk about. And that's exactly how it looks before momentum returns. Attention always follows price, not the other way around. So when the market starts moving properly again, interest will come back on its own. But this is where retail investors come back in and they buy expensive. And this is always the pattern that repeats. And something else that I want to talk about here is about regulation and structure, especially for Q1 of 2026. Another important piece that we need to add to the puzzle. Q1 2026 brings the Clarity Act. This matters more than people realize because we would have less ambiguity when it comes to regulations. We will have less manipulation and clearer rules for institutions. Because institutions don't need hype, they need structure. And when we have structure, liquidity, and risk appetite, all of the three aligned, you get sustained trends, not just bumps and dumps, which happen pretty quickly. Even the CEO of Binance, CZ, is talking about a potential super cycle. He posted that on X the other day, not because of memes, not because of hype, but because the macro ingredients are all aligning. And people who understand how crypto works, how the macro environment works and the economy, they can see that well in advance. Unfortunately, retail investors come to realize and come to see that when the prices are already high. I hope you're positioned for that and you are preparing yourself and you have entered the market. At the same time, silver is up today, gold is at record high level. So it's a good time to start considering to take profits and to know how to position if you're invested in commodities, how you would exit the market. So that's for me today. Thanks so much for watching. I will see you in the next video.